a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Now we're going to talk about preferred stock ETFs with our ETF Research Director, Nina Mishra, who joins me here. In order to understand preferred stock ETFs, you first have to understand what a preferred stock is.
Yeah, sure. So preferred stocks are hybrid securities. They have characteristics of both stocks and bonds. They do not have any voting rights like common shareholders, but they have higher claims to earnings and assets of companies. And in the event of bankruptcy, their claims are senior to claims of common stockholders, but junior to claims of bondholders. So they lie between stocks and bonds in the spectrum. They can either be perpetual without any maturity date or have very long-term maturity like 30 or say 50 years.
Because of the bond component.
Yes. They may mostly pay fixed rate of dividend. At times they pay floating rate of dividend also at regular intervals. And like bonds, they are usually rated by credit agencies.
This can be a difficult concept for newer investors to get their head around. So taking it to the next level, why would you consider preferred stock ETFs for your portfolio?
Yeah, that's a good question. First of all, they pay very juicy dividend yields in the range of around 5 to 6% or even more than 6% at times. Then they have low correlations with stocks. So they provide diversification to a stock-centric portfolio, and diversification is very important for longer-term risk-adjusted returns. They have much lower volatility than stocks, so they provide stability to the portfolio, which is like very important in these uncertain days. And most of the preferred stock dividends have the same, they're treated in the same manner for tax purposes like common stock dividends. So they have the tax efficiency as well. Now, because of the bond component, bond-like characteristic, they do have interest rate risk.
Yes.
So they do not, they are expected to fall in the rising rate scenario. Now, in the current environment, when rates may rise, but they are expected to remain lower for longer. So that means after the first rate hike, the monetary policy may still stay accommodative for a long time. So I think the impact on preferred stocks may be minimal. And secondly, the two ETFs that we are going to discuss, because of some special features, they're expected to do well even after the Fed hikes rates. And both these ETFs, I must add, that they have minimal exposure to the energy sector, which energy sector, as you know, has higher chances of default. So that also reduces credit risk for these two.
And
ETFs.
These are the ones we're going to talk about next here. So the first one is the iShares S&P U.S. Preferred Stock Index.
Index ETF. The ticker is PFF. It is the most popular and most liquid ETF in the space. Charges an expense ratio of 47 basis points, yields around 6%, and it is up 3.6% year to date. This has a lot of exposure to banks, more than 40% and about 20% to diversified financials. So as we know that banks are expected to do well in the rising rate scenario, so this ETF I expect it to do well even if after the Fed hikes rates.
And then there's the PowerShares Variable Rate Preferred Portfolio Fund.
The ticker is VRP. This ETF holds only variable and floating rate preferred stocks, and which minimizes the interest rate risk for this particular ETF. So this could be a solid choice for income-seeking investors in the rising rate scenario. It charges an expense ratio of 50 basis points, yields around 5.5%, and this is up around 3.3% year to date.
All right, do you own either one?
I don't.
All right, check out more ETF information in the ETF section of Zacks.com if you're not there already. Just go right to the homepage and use the Funds tab in the top toolbar to get there. And don't forget, if you're watching our videos in syndication land, specifically on the YouTube platform, you can subscribe to them there and even comment on them. Feedback's always welcome. With Nina, I'm Terry Ruffalo.